China's stock market in freefall. Thank you for joining us for another Bank of Cardiff newscast. Panic selling has wiped more than $3 trillion off the value of Chinese listed companies as the Shanghai Composite Index plummeted by almost 6%, taking the total drop in share values to just under 30% from its June peak. This despite China's efforts to staunch the flow by cutting fees and relaxing borrowing rules to try to encourage investors back, and a promise by stock market regulator, the China Securities Regulatory Commission, to address the accusations of short selling. The regulator also reduced the number of new companies entering the stock market. Only 10 initial public offerings will be allowed in July, and the amount of money raised will also be lowered from recent levels. The slump follows a record-breaking doubling of stock market value that began last year in response to the official view that stocks were too cheap. The resulting rush to exploit the enthusiasm of investors with share offerings caused an unprecedented spike in activity. However, China's manufacturing output has continued to slow, and despite bullish predictions of GDP growth of around 7% this year, it's widely accepted that actual performance could be half the official estimates. While much of the boom speculation was on tech stocks, shares are falling across the board. Individual investors are being hit hard, having borrowed from brokers to buy securities. The falling prices have increased the number of margin calls demanded by brokers for additional cash from investors. If these margin calls continue, investors may be forced to sell other assets to find the funding. It's estimated that around 12% of Chinese households now own shares. Almost 90 million citizens are shareholders, and up to 1.4 million new investors open accounts each week, tempted by rocketing prices. More than 20 million trading accounts were opened this spring to take advantage of the rising market, most of which have experienced significant losses. So, who's to blame? Well, rumors abound about what's causing the slump. Some news articles are blaming foreign interference, alleging that overseas investment banks are short selling so they can benefit from falling prices. Others are suspicious of organizations closer to home, claiming that the market is being manipulated by private money looking to sell short. Ironically, it's the brokers who may suffer most from China's emergency stock market intervention, as measures designed to support the market and save its investors from ruin hit the earnings of securities firms. As the fight continues to prevent whole-scale market meltdown, it's difficult to predict what the fallout from the losses will be. If the next GDP figures show a significant slowing of growth, it could well add to China's woes. Join us later this week for another Bank of Cardiff newscast, and remember that all our newscasts are available on our website, and that's www.bankofcardiff.com/newscasts.